Hello, I'm Connor Bryant, a partner at Bryant Asset Management. Over the next few minutes, I'll provide an update on the global financial markets and their impact on our strategies. I will also provide our expectations for the year ahead. Looking back at the first quarter, we saw continued divergence between North America and the rest of the world against a backdrop of volatile oil prices. Persistent themes included continued strength in the US dollar, stimulus efforts by the European Central Bank, and speculation about when the Federal Reserve will begin to raise interest rates. In this environment, we expected to see developed international markets outpace US and Canada, and were not surprised when they did. In US dollar terms, the MSCI All Country World Index, which serves as a proxy for global equities, was up 2.31% the quarter. Europe and Asia outpaced the Americas, driven by central bank stimulus efforts. Returns in Europe and the UK were stronger in local currency terms. At a more granular level, US real estate and US small cap stocks set the pace as most markets delivered positive results. Global bonds were a notable exception as the Barclays Global Aggregate Index fell 1.92% for the quarter in US dollar terms. Currency was the big story here, as strength in the greenback hurt results for non-US dollar denominated issues in most countries. At the sector level, healthcare and consumer discretionary led for the period. Utilities reversed course from last quarter and trailed the pack, faring even worse than energy. US equity markets, represented by the S&P 500 index, were up just under 1% for the quarter. While the positive result marked a continuation of the 6-year bull market, the pace was significantly slower than the 5% gains seen during the fourth quarter of 2014. On the fixed income side, the Barclays U.S. Aggregate Bond Index gained more than 1.6% for the quarter, with U.S. high-yield bonds performing even better. In this environment, our strategies started the year off on a strong note, with positive results everywhere but in emerging markets. Our more aggressive strategies fared well on the strength of the small caps, high yield, and active management. With the U.S. Central Bank poised to raise interest rates and the European Central Bank engaging in stimulus efforts, we expect developed international markets to continue to outpace the U.S. On behalf of everyone at Bryant Asset Management, thank you, as always, for your trust and confidence.